One.
There you go.
Good morning, good afternoon, good evening around the world. My name is Doug Brunke. Thank you, Jem, for setting this meeting up. And thank you all, both the Global Chamber team and our members, for participating and being involved in such an important topic. When I started Global Chamber 10 years ago, I was lamenting that nobody talked about global, that not enough people were, it wasn't an active part of the conversation by most people, nearly any people. And now that has changed fundamentally, at least on the US side. It's been global conversations have been happening in places like Germany and Austria, for instance, where over 50% of their GDP is exports. That hasn't been historically the case in the United States, where only about 12% of GDP is product exports. The US does pretty much better or better than average on service exports, but generally not very well. And that's been an inspiration for us to help more people understand what the opportunities are. And now, with all of the changes, particularly this year in 2025, and other activities that are going on around the world, including increasing prosperity and countries shifting in a variety of ways, including geopolitics. There's a lot going on, and that's why we're talking about global. And we're very fortunate to have Jeff Cartwright here today talking about his perspectives, because he's right in the heart of a lot of the activities, particularly Mexico, US, so the North America bloc and how it's interacting with the world. The other piece, other than the US issues around not being as effective with exporting as normal, FDI, foreign direct investment, historically is quite strong for the US. And some of the things that we're seeing and why everyone's talking about global are the US efforts to get more foreign direct investment and to shift some of the dynamics more toward benefiting the US even more than has been historically. That is creating these geopolitical and also, quite frankly, real strong challenges on people's parts who are doing importing and exporting. Another really important topic is Mexico. Mexico has benefited significantly from NAFTA originally, and now USMCA, and I would presume even moving forward, because of the automotive and aerospace industries, advanced manufacturing, information technology that they're exporting into the US. That proximity to the US and its markets is very important for them and for the US, because of a variety of different reasons. The mega region, US, Mexico, and including Canada, it creates a dynamic on the world stage that's critically important. Jeff, again, is right in the middle of that. He's based in Texas, so he's along the border. But beyond that, his interactions and connections with the community are really important. So, Jeff, thank you for kicking us off today and giving us a perspective. Certainly, we'll get one on the tariff side of it, but overall on trade and what some of the certainly challenges are. But more importantly for businesses, what are the opportunities given these shifts, given what's happening, even as late as hours ago? How do we react to what's going on in Vietnam? How do we react with what's going on in Mexico by those governments and by the US government? Thank you for sharing today. We look forward to learning more.
Sure. Let me start out just a brief part about my background. I have had I'm predominantly manufacturing, which then spills into supply chain. 40 plus years of that. I have built 6 large factories around the world. I have had factories in France, Germany, Portugal, Italy, Australia, Canada, China, and US. And I built a couple of factories in Mexico. So I have a little bit broader experience than just the US Mexico piece. I have built 2 large supply chains in China, which are a number of billions of dollars for a very complex multi-divisional US company. And I think we had 38 operating companies broader than just the US-Mexico thing. But what I wanted to talk about is, the headlines out there are about tariffs probably dominating every country's headlines almost on a daily basis. And those tariffs, I think there's been 59 announcements by the US's current president since January 20th. So that makes the world quite dynamic. And what I find is a lot of companies who would like to exit the US's formerly largest trading partner, China, and move elsewhere because of geopolitical risk, or maybe President Trump wants to move more manufacturing positions into the US, have caused a lot of concern. And there's a huge amount of tariff announcements relative to China. First thing I want to go back to, in the perspective, we've been in a trade war, the US and China, for 7 years now. This is nothing new. What is new is the level of tariffs and the seriousness of US manufacturing elsewhere. Over the last 7 years, the bulk of that relocation of manufacturing is to Southeast Asia. It would be to Thailand, Vietnam, Malaysia. It has been some to Mexico, but not a lot. And we see huge gains. For example, just one thing that was in the announcements about Vietnam yesterday. Vietnam used to import from China $50 billion worth of goods 5 years ago. They're now importing from China $137 billion worth of goods. And our imports into the US from Vietnam have increased almost that much, if not more. So one of the geopolitical things that I think President Trump is trying to react to is, again, there's this notional trade war between the US and China. We view each other as an existential threat to some extent, that we're global political rivals. We're certainly economic rivals right now. We may or may not get to armed conflict at some point in time over the South China Sea or Taiwan, but for the time being, we're engaged in economic warfare. Trump believes that a lot of the products that were formerly made in China probably still are, and they are shipped south to Vietnam. They are lightly touched, maybe as little as just relabeling from made in China content to made in Vietnam, and then shipped on to the US to avoid tariffs. So a lot of what we see is, and including in yesterday's announcement, is going to be a two-tiered tariff. It's going to be 20% on Vietnamese goods and 40% on transshipped goods. Now, how do we determine what's transshipped or not is going to be an interesting thing. But I want to move us back into the trade between the United States and Canada, the United States and Mexico. We have had content laws in the NAFTA agreement and now the USMCA agreement for a long time. In other words, in order to qualify for zero tariffs from Mexico to the US or Canada to the US, you have to reach a certain content level of made in Mexico or made in Canada. That level for ordinary goods is 51%, a majority, not counting packaging. So if you're counting packaging and your product is 50% from, 51% from China, and you think you're going to get there with 10% of that content being packaging in Mexico, you will pay the Chinese tariff coming into the US eventually. So we have content rules, and by and large, Canadian companies and Mexican companies comply with those rules, and therefore it's subject to 0% duties and tariffs with those countries. If we look at what he did yesterday, what Trump did yesterday is apply that general rule to Vietnam, a tariff on Vietnam and Vietnamese goods, and a tariff on goods that he thinks are not Vietnamese originated, or the content is not largely Vietnamese. I think that that's going to go forward, Doug and Mohammed, across everywhere. There's going to be two sets of tariffs for any particular country. Maybe if it's a very small country, there might be a single one because of the documentation, but I think in general two. One, again, to, in Trump's mind, protect the US from Chinese evasion of tariffs. And the second one to be whatever it is to, in Trump's words, to level the global trading platform. So I think that's one. The other one I want to point out, just kind of put everybody's head in a emotional level perspective, is that we are in the world of 724-hour news. If something has a negative twist on it, that's headlines. If it, our common statement is, if it bleeds, it leads. If there's something that went wrong, it's headlines. So I want to point that out about tariffs. Everything about tariffs in the headlines is going wrong, generally speaking, because it's negative and it affects trade. However, in 2008, 2009, the United States and the rest of the world went into what's called the Great Recession. We suffered badly because of financial risk and lots of unemployment and lots of negative growth in productivity and GDP. We came out of that recession in 2009. And since then, the US economy has been pretty healthy. Like yesterday, 4.1% unemployment. So pretty healthy rate for unemployment. However, what happens, and I want to mention this from a perspective of watching maybe too much news, 80% of every trading day on our stock market since 2009 has been positive. In other words, that's the positive, the trading of stocks, bonds, and all of that stuff has been up 80% of every day since 2009. However, 80% of the headline business news has always been predicting the next downturn or recession. We like to harp on what's negative, and we don't really have a lot of time to spend or whatever on positive stories. I think, as Doug mentioned in the opening part, the world is in a great place. I think after we get done with this round of tariffs and we know what the playing field is, we will see great innovation in many countries. Trade will be booming again, less poverty around the world. There's a lot of positive things going on, but our headlines are dominated by the tariff situation right now. I think that's a perspective we need to keep in mind. We also need to keep in mind this about how President Trump seems to negotiate. He negotiates by putting out extraordinarily negative positions to begin with. Huge, huge tariffs, like, and again, back to Vietnam, a 46% tariff. That's to get shock treatment, to get Vietnam's attention, and then the negotiations happen after that, and the outcome is lower than that. For example, the outcome is 20%, and it was 46 85 days ago. That's his normal style, shock treatment, and then come to the table and let's negotiate. So I think we need to keep all of that in perspective too. And I think perhaps by September 1st or so, we will have a going forward perspective that this is what the tariff situation is. This is what it's going to be for the next 4, 5, 10 years. And we'll only be able to react to that. And I think there's a lot of positive things once there's stability and once there's some predictability in the market. Then things will move back and forth. The other point I want to make is I think President Trump is somewhat right about relocating manufacturing to the US in some areas. I would say that's high tech, defense-related industries, possibly pharmaceuticals, certainly semiconductors, maybe in some other areas. But as Doug mentioned, we don't really do that much in international trade. 13.6% of the US economy overall is imports. We are a service economy. We are not a manufacturing economy any longer. We do not have enough individuals who would like to work in factories that we could double the amount of manufacturing we do. We can't. As I mentioned earlier, our unemployment rate is 4.1%. We simply do not have enough people that wish to work in manufacturing. So there's an upward limit to how many of those jobs that Trump is claiming is coming, which is very positive for the countries around us. That means we need that manufacturing in a geopolitical sense, leaving China and moving to countries closer to the US or more friendly to the US, maybe closer geopolitically or maybe closer geographically. I think that presents a great opportunity. And again, I deal primarily in Mexico, but I also have projects going on in Colombia, El Salvador, and other places. I think the other thing to keep in mind when we're looking at relocating production, we need to keep in mind, what does the US import from China, or what does China export to the rest of the world? And the number one category is consumer products. Consumer products as in small tabletop appliances, like a coffee maker or a toaster or a blender or other things. We don't make those in the US. They're not coming to the US. We don't make those entirely in Mexico. So that means what we don't make in Mexico is things like lithium ion batteries. So if yours is a charged product and you're going to use a remote from a plug, we don't make that in North America in anything related to consumer products. We may make some for EVs, but we don't make that in North America. We also don't make small fractional AC motors like run the mixer or the blender that I mentioned. Those are not made in North America. So that means, small DC motors are not made in North America. So that means most of the supply chains that we're building, because we buy finished products from China, we need to buy a finished product that's with a power cord, with a small motor in a package from somewhere. That leaves opportunities and holes in the supply chain. For example, when I reach out to India or Vietnam for components, it's because we do not have that manufacturing in North America. So moving out of China also then provides, I don't know, 20, 25% of the product is coming from some other country other than Mexico in this case. And definitely not from the US, because we don't have that manufacturing. The same thing would be true back in DC motors. The rare earths is one of the headlines out there. There's a lot of rare earth magnets in an automobile and other things to drive small DC motors. So those are not made in North America. So I think that opens up other places for development over time to develop not necessarily rare earth mining, but the processing of that, which is 90% in China. Why isn't that 50% someplace else? There's a lot of other things when you're looking at the relocation of things. So I wanted to set the table on that. And then I do think the tariff situation, and I think these are some takeaways. Again, we've been in a trade war with China for 7 years. It is not likely we will ever return to the situation we were in 7 or 8 years ago. There will be tariffs on China. Right now, they average about 55%. We might have some negotiations around the fringes, but we're going to have high tariffs on China for the foreseeable future. For those companies that I coach both in the US and Mexico, we need to stop waiting for a solution and start reacting to the situation. We need to stop thinking that next week there'll be a new trade deal with China and the tariffs will go down and all of the manufacturing that we might have moved somewhere else, let's say to Turkey or somewhere else, we're then going to suddenly move back to China as soon as that negotiation is over with. That is unrealistic. The reason it's unrealistic is supply chains and manufacturing are difficult to move. Having been a chief operating officer and chief executive officer of half a dozen companies, if I'm going to pick something up and move it, it's painful. I've got to qualify a factory. I've got to buy new tooling. I've got to go through a startup. There's risk of that. This is not like going into a catalog and choosing the next item over. This is a 1, 2, 3 year event that I'm only going to do every so often, probably once every 10 or 15 years. So whatever changes and decisions we make today, as a CEO who's had a lot of manufacturing, I'm making that decision for the next 10 to 15 to 20 years. I'm not making it for the next 6 months and then to snap back because it's just too difficult. So we need to realize that these trade changes due to tariffs are somewhat permanent, at least permanent for the foreseeable future as we do planning, 6, 8, 10 years, and stop thinking about it in a transactional basis that we're going to go do something and then we're going to go back and do something with someone else quickly. There has been this previous notion with a lot of consultants out there called China plus one. That makes sense if your global volume is big enough to maintain 5, 10, 15 manufacturing plants. But if your global volume, as in what I said about consumer appliances, is somewhat limited, you're not going to tool that product and you're not going to establish production lines in 2 or 5 countries. It's too expensive capital equipment wise, too expensive human resources wise to try to staff that many organizations. You're going to do it much simpler than that. China plus one was never a good strategy. It just can't work on a global scale. Most of the volumes that we buy, most of the demand that we have throughout the world is not big enough to support that strategy. Having said that, I think I've talked for 23 minutes. I told Doug I would talk for about 20. And I want to talk a little bit about common mistakes by the company that's importing from China today as they look at it moving production to someplace else. And there's a few mistakes that they make that sometimes doom that effort. The first mistake they make is thinking Mexico, Colombia, Turkey are just like China. They're not. China is a very developed manufacturing sense. You can get on an airplane. You can fly over to the Canton Fair or the Shanghai Hardware Show. You can meet with 10,000 different companies if you had enough time to go do that. You can point at products that are somewhat close to what you have, and then the Chinese factory owner will go out and develop a similar item for you with limited direction, and he will go ahead and build out the supply chain for you. When you look at that product that has never been made in Mexico, and it has 70 or 80 components, you have 70 or 80 projects, not a single project like you might have in China. You've got to move 70 or 80 things or find 70 or 80 supporting factories. So very difficult. But a lot of companies assume it's as easy as China and they under-resource it. The second part is because it's so easy to get things in China historically, their assortments, their product assortments are way too broad. And they may have 1,000 items in their product line. What they need to look at is rationalizing that product mix first. There's a gentleman out there from some time ago called Pareto, and he published Pareto's Law, which says that in this case, 80% of your profits come from 20% of your items. So why would you move 1,000 items? Now, in my prior lives, I've helped buy 33 companies and I've done some turnarounds. When I look at a profitability analysis by item, it's not quite Pareto's Law. The first part is true, 80% of the profits from 20% of the items. But when you look at the bottom 20% of the products, they are not zero profitability, they are negative, they are losses. If you were to rationalize your product line in advance and maybe get rid of those underperforming items, you would double your profits by getting rid of 20% of your items. Double. This has been proven. There's plenty of studies on that. That's the first thing I would go do prior to resourcing is what am I going to resource? And let me resource the ones that we make money at that are my biggest cost issues. The second piece that goes similar to that is a lot of times the company will look at their highest volume item, which is probably their lowest profitable item, the lowest gross margin. And what they have done over time, let's say 20 years of being in a country, they have introduced different items. They have an item that sells really well, but it's at marginal profitability. And the marginal profitability says this is the other items that are sourced at that same factory, let's say in China, are far more profitable. So the Chinese factory will use the profits from the higher margin items to subsidize production on the lower margin items. In my case as CEO selling to Walmart, I did the same thing. I had 15 items selling to Walmart. I had, let's say, 10 or 12 of them at 35 or 40% gross margin, and I had one at 10%. The one at 10% is my highest volume item. And so the mistake that people make is that they think that they need to have the full assortment in order to protect against a competitive inroad. I think that that's true, and I think it's largely false. I don't think you need to protect every price point. I think you need to be profitable. I think that's the number one objective for any company. So anyway, so I have this one that I've been protecting. My factory in China has been protecting. And because I now have a trade war, that's the item I want to move. So I'm going to give you the real case is talking to some Mexican companies about moving that item. I have 12 companies that have refused to even bid on it because no one is in business to make a single item and lose money. They are in business to make 15 items and make money. So there's that illusion of I'm going to take the largest volume item. Everybody's going to be thrilled with that, but nobody's thrilled to lose money because we've chosen the wrong item. We need to choose an average mix of the product, just like the same average mix that we're sourcing from China, from India, or whatever we are today. That is make a profitable supplier. It makes a profitable company. Picking and choosing on some other basis is not productive. The other one I want to go at is in terms of mistakes that doom a company's sourcing effort is using the people that you have today that have been buying and sourcing in China and assuming that they can buy and source, let's say, in Turkey. It is a different mindset. We get used to patterns of behavior. We develop certain cultural practices. We get used to that. We don't like change as people. No one does. The only person in this whole world that likes change today is my granddaughter with a wet diaper. That's it. Everybody else resists change to some extent. So we're asking people who have a full-time job, and in the case of the tariff war and huge trade movement, more than a full-time job, to suddenly carve out a piece of their day to go work on reshoring elsewhere. Typically, they don't have the engineering skills because we're talking about moving stuff to another factory. That's engineering work. That's detailed manufacturing work. That's, again, in my case, 80 different parts, not a single product. It is so much more complex. So we're asking this overloaded person who has been in love with what they've been doing for 15 or 20 years to suddenly do something that they're not skilled to do, that's uncomfortable, and is far more complex. I think that means that the effort will fail. I think what we need to select is someone who is, let's say, somewhat dissatisfied with the status quo, can be assigned to go do this task on a full-time basis and not be interrupted by a customer call or a delay in transit from some sort of ocean carrier or something that requires them to go ahead and react to it and then put in the resourcing effort as the 15th or 30th thing they're going to do today, which means they didn't do it today, they're going to do it next week sometime. If it's truly a priority, we need to assign it as a priority. If it's truly a priority to reset your company's financials, then I, as CEO, that's the first question I ask when I come in the morning. Tell me about this effort, not the last one. This is the first thing. If it truly means the survival of my company, that's what I spend my time on. So I just wanted to point out a few of those. I've talked a little bit geopolitically. I've talked a little bit about resourcing, moving to another factory. I don't care where it is, another factory from one part of China to the other. It all has the same difficulty. It all has a bunch of parts. It has a lot of intense effort. So therefore, we're not going to do it lightly. So we want to be studied. We want to, be dedicated to the move. We want to resource it appropriately. And then we want to execute that move violently. There is no such thing as when you go to a factory that you've been buying, let's say 10 items from, and you talk to them, Francis, and you say, hey, I'm going to move one item. Well, you know what the factory knows? You're going to move all the items. It's just a question of time. So what does the factory go do? They spend their time working on their next customer, and you get less attention than before, which means that you're likely to have lesser talented people. You're likely to have quality issues. You're likely to have service issues. That's assuming they're cooperative. If they really are, let's say, a little bit upset, they may not be cooperative at all. So if you're going to make a decision to move something, make it and move everything as quickly as you can, all in the same day if possible. There is no slow divorce that is good. It is rapid and it is fast. Having said that, I'll take whatever questions you all might have. And I think
really good summary. Looks like you're getting a standing
Hello?
ovation from Jim. Thank
Okay.
you. What questions do people have? I have a few questions, but I'll let you guys ask the first ones.
Yeah, great. It's Francis. Fantastic. I love all of the information you've shared with us. If I could ask you, from your experience, can you speak about some of the contracting strategies in establishing or reestablishing a supply chain? Some of the difficulties and some of the potential tricks that you use, not tricks, but approaches you use to contracting.
Well, I think anytime you're starting a new relationship, and I would say customer to a factory, there's a bit of a dating process in that. It's not so important if I was, and again, I've dealt in China for 25 years. It's not so important in China because they're used to, let's say, a Western business culture. They're used to Americans being very much black and white, very quick, et cetera, in terms of time. Other cultures are not like that. Other cultures, particularly, again, I deal in the Mexican culture. I make this, let's say, highly socially comment that is not well accepted in the US, which is if a Mexican factory owner thinks he can make a lot of money off of you, but he doesn't know you and hasn't developed a degree of trust with you, he will not sell you. He will not sell you at all. He is more loyal to his family, and most of them are family-owned businesses. He is more loyal to his state and the people around him than he is to making a profit. Certainly he wants to make a profit. I'm just saying the order is a little bit different. And in my experience in China, profits first, and then there's some other things in my experience in Mexico, Colombia, and others. The family culture, the business that's been around for 100 years, that's more important than a single customer. So you've got to spend far more time, if you will, Francis, on relationship building, which is very frustrating for us Americans because we want everything done now. And I'll give you, for example, I can get quotes in China on a product, let's say in 2 to 4 weeks. I can push back and I can have a revised answer in another 2 weeks, and I can be placing a purchase order, let's say maybe in 2 months. My experience in Mexico, that's 5 or 6 months. I've got a date. I've got to want that. I've got to get that company to want to do business with me. And part of that is, again, as we do business around the world, it's with who we know, pretty easy. I now know some of you. Who we like, really quite easy to go do. We can have dinner. We can have a few conversations. And who we trust. And who we trust is difficult. So more on the relationship building for a simple answer.
Great. Thank you, Jeff.
Thank you, Francis, for the question. Any others, please?
Yes. May I ask a question?
Sure.
Yes, please, Mohammed. Please go ahead. Based in Ankara, Turkey.
Yeah. Thank you, Jeffrey, for a great information and the presentation. From your experience of manufacturing and the supply chain, I think this trade war that's going on is, and a person has been in China four times. It's like to how you say, to make the manufacturing much difficult for the world because the HR, the global manufacture is concentrated in China, with HR, with human resources and manufacturing infrastructure. But maybe in the near future, we need to have not only access to finished consumer products, maybe we'll have to be more creative to manufacture stuff to be ready to ship for consumers. For example, emerging markets in Africa, for example, or to have half-made products and traveling them around the world and make it finished product. It's just an idea I had in mind, and I would like to have your opinion. And thank you very much again.
Yeah, I think you're absolutely right. China's the manufacturing powerhouse of the world. It is. But I also remind you that in the late 1970s through the 1980s, China was nothing, manufacturing nothing. So anything is possible if we dedicate time and effort to it. I mean, seriously, their wealth per person was probably not in the top 150 countries back in the mid 1970s. And now it's up pretty high on that scale. So we can do anything, effort, time, resources, and particularly, and I mean this kind of effort, thinking effort to rethink things. But I think you're also right in this. Many of the markets around the world are a lot smaller. Therefore, maybe what we need to do is kind of a mass customization. We produce the bulk of the product somewhere, and then we flavor it. And I don't mean just packaging. We flavor it for the country of use, where the demand is going to be. And sometimes that is as simple. If we look at electricity, our power grids are different. The US is different from Europe, is different from other places. And we figured out how to customize that for those markets. But maybe we have to go a couple levels deeper and be a lot more in tune with those markets.
Thank you very much.
Thank you very much.
That answer your question, okay? Thank you very much. While we're waiting for more, or did I see Guy? Were you asking a question or scratching your head?
Do you know what? I was turning on my camera and looking to ask a question. So
Cool.
Thanks, Doug. Jeffrey, that was amazing. Incredible insights. Thank you. The question I had is, do you think the US are capable eventually of developing a workforce to start building in their own country? Isn't they willing to do that, or are they going to import from friendlier jurisdictions? Long term, do you think that's going to happen?
A short answer, no. I think we'll export engineers and expertise to help people to move along the spectrum of development, but I don't think we'll be exporting our workforce. We need, by the way, somewhere between 2.5, 3 million, I'm going to say, legal immigrants to the US per year just to keep our economy running. So a little bit of what's in the headlines about anti-immigration and stuff, it's okay, I think, from a national security standpoint to want to know who's here, but it is not okay from a growth in our GDP over time. We need workers. We need talented workers from a lot of different places. And I don't see that happening. I think, in terms of, again, back to one of my earlier comments, is Trump has, I think it's like $5 trillion of new investment announced for the US. I don't see how we staff those factories. I think we run out of people at some point, which very quickly means, let's say maybe $1 trillion in investment at the US and $4 trillion someplace else for those kinds of products. And we're not at that stage yet where we're offloading things because he's only been in power this time, 4 or 5 months? Everything's about headlines. Everything's about a lot of other things. Now we need to get down to the practical work that it takes to go do this. And that's difficult.
Thanks, Jeremy. Sorry, thanks, Jeffrey. One sneaky question just to add on to that. I mean, all this tariff news that's happening, do you think if the government changes when he's out of power and perhaps Democrats come in power, do you think tariffs are going to stay long term, or do you think they could be in and out as quickly as presidents are?
I think, yes, I think they'll stay long term. Let me give you this. The first Trump administration negotiated with China for about 2 years before he started engaging in tariffs. Then he was voted out of office. Okay. Then the next administration, the Biden administration, did not relax a single tariff on China. Now, when I make a broad statement like that, maybe we can find an exception, but did not relax on China. In fact, more goods were covered by tariffs, more things were restricted in trade from China than previously. Now we have this administration even more anti-China with trade. So we've gone 7 years. We're in our third administration. The only thing our two major political parties can agree on right now is hate China. That's the only thing we really agree on. Now, I'm being a little bit simplistic with my language, but it's the only thing we agree on is that we think China is an existential threat to Western democracy. And I use that term carefully because some of these countries, like Turkey, is a Western democracy. You look appear to have a bridge in London behind you. China's stated geopolitical policy is to be the superpower. And that means it thinks the Western democracies are decadent and falling apart, and that's their strategy. So I don't think they're just a threat to the US. They're a threat to Mexico. They're a threat to Canada. They're a threat to other democracies around the world over time. And I think other countries are realizing that in some ways, particularly EVs or something else. Maybe it's only in a particular segment, but I think we realize that in some other ways that China is a bit too aggressive economically for most of us. So I don't think things will roll back. They may get a little calmer, but I think the situation with China is there for a considerable amount of time. Maybe one of the reasons we invested very heavily in China when it entered the WTO, and I mean massive investments by US companies and other companies around the world, is in the hopes as the economy inflated, as the people became better off economically, eventually a Western style of some sort of democracy would break out. That has proven to be untrue. It was a bad assumption and a bad strategy. And what we have is now a very economically strong country that has deployed, technology to control its people even more. It's more of a dictatorship today or autocracy today than it might have been 20 years ago.
Jeffrey, thank you.
Thank you, Guy. I wanted to, let's see, we've got about 10 minutes or so, and please feel free, anyone, to interrupt and ask another question. There were a couple things that I wanted to quickly follow up on, one of which was a comment you made that when there is stability, ... And so when do you feel like there will be some stability? And in particular, what's come up, obviously, in the last months is that there's a lot of people circling around foreign direct investment, feeling like they feel things are unstable, there isn't certainty. And I think for those of us that have a view as Americans, there seems to be more stability than a foreigner might have, given that it's so odd, or there's so many oddities going on. But as an American, even though it's odd, there's more stability than a foreigner would see. So I guess my question is a little bit in two parts. From a stability standpoint, when will Americans feel more like there's stability? And then for those that are less familiar with the craziness, when do foreigners understand that this is a long term? It's going to take them longer, right?
I think you're right. First of all, I think the announcements on reciprocal tariffs on April 2nd is certainly what set the whole world off about major instability, throughout the world. and then quickly followed up on April 9th with the 90-day suspension of those tariffs, but a 10% global minimum. So I'm going to go back to Guy's comments. I think that 10% global minimum is going to be viewed by the next administration and our legislature as a way of tax on imported goods and a way to support the American economy. Rightly or wrongly, I think that's going to be a permanent feature. When we do a tax, we rarely roll it back. No country does. When you put a tax on it, it usually becomes permanent. But having said that, I think stability, Doug, will be somewhere, I think, in late third quarter, fourth quarter for global trade in terms of whatever the tariff levels are going to be, they're going to be defined. They'll be announced, they'll be out there. I think negotiations take a long time. Like with Japan and India, negotiations are taking a considerable amount of time. They may get better than that, but they don't get worse than that. So that adds a degree of predictability and a degree of stability to move forward, knowing, let's say, again, in the case of Great Britain, 10%. Well, it's 10%, and now we have some iffiness in some other categories, but at least you're able to start planning. So I think the rest of the world will start to see that probably early next year. I think we have to keep in mind that the current president loses his mandate to govern during the midterm elections in November of next year. That is to say, I can't see, we always change power in the legislature about halfway through the president's term. I think Trump is trying to, if you will, I think his strategy is to do everything, everywhere, all at once, because he sees a clock winding down on him in November of next year with people taking office in January. So I think certainly by the end of next year, that will be settled and we'll get to, we're always going to have turmoil in the world. We're always going to have some instability, but I think we'll have a much calmer period, a much more, a period where we can predict the future a lot more than we've had over the last couple of years.
A guy with Convera is more familiar very specifically with the foreign currency markets. Yep. Guy, is there anything that the currency markets are telling you right now in terms of where things stand and where things are going? Did you have any comments that you wanted to add?
Well, I'm not a market insights guru, Doug, so I don't want to sort of put it in anyone's heads, what may or may not happen, but certainly the devaluation of the dollar is causing a lot of upheaval across all businesses in Europe, and I think it feels like it might continue on that same vein. But happy to share later on with anyone else some more specific insights if people want to reach out, but so we have people there who can do that better than I. Okay.
And if you wanted to spend some time at the Global Chamber London event on Tuesday and just kind of share how that disruption, what you see is from a disruption standpoint and how that's impacting people, that would be awesome.
And Jeffrey, just to hop on with regards to currency question of what do you see is the trend, and we see obviously the U.S. dollar being the currency of reserves and the key currency for the world. What do you think that position of the U.S. dollar will be, with all this going on with the tariffs, et cetera?
Mm-hmm. Well, I see there's a sequence to it. I think tariffs settle, and then I think the dollar settles. But whatever that is, I think there's a sequence when one happens, because again, devaluing the dollar, whether we do it intentionally or whether it's done through foreign trade, happens at some point in time. If to again level things out. Do I see the dollar not being the reserve currency? No. I mean, we have to look at some of the size of the U.S. 26% of the global economy is in the U.S. That's pretty huge. Guy could probably speak to that, but in terms of foreign trade transactions, the amount that's conducted in the U.S. dollars is much higher than that number, probably 3 times that number. So what is, when you're talking about whether it's not, then you have to talk about what might be. And I don't see that being the RMB/1. I don't see that happening. I think the euro has made that attempt over the last 25 or 30 years, and that hasn't happened. I just don't see the alternative to shifting what the transactions are done on, at least in the near-term horizon. I do see the dollar, moving up and down in response to the trade negotiations and where the tariff levels are. Then I see it being flat, and then we've got to look for some alternative, but I don't see that right now.
Very good.
But that's me, and I'm not in currency like Guy is.
Thank you for those thoughts. We just have a couple minutes. Is there anything, Jeff, that you would like to state in kind of conclusion, or anything either that you left out, or anything you'd like to leave us with?
Yeah, I want to do this. For me as an executive, to source in China was always easy. We have certain platforms out there like Alibaba or major trade shows. For me to look into a country like Mexico to find manufacturing, it's not very transparent. For example, I'm going to look at Mohammed right now because he's in the upper left and he's been there for a while. I know Turkey has a very vibrant, very strong manufacturing economy, but I don't know what Turkey makes. So it's not an alternative to me. And I think we need to do a lot better job with visibility of what is made in our countries today, what could be made that's on the same production line. And I'll make this comment that I made to the Mexican companies last week. I go, listen, you're our biggest trading partner. I'm telling you, what you're making today is not what the US companies want to buy. Okay, you might, again, I'm not saying abandon that, because you can still grow sales at 1 or 2 or 3% of what you're doing, because our GDP is growing at that. We want to buy what we've been buying from China. That's not what you make. In other words, I don't want to buy, most cases, what's made in Turkey. I want to buy what I've been buying from China. I just want it made in Turkey with Turkish labor and Turkish manufacturing lines. And I'm not sure we have that perspective that if we want to grow globally, we need to look at the demand side and not at the production side. We need to look at what people are buying and then change our processes, the 5 or 10% it takes to go do that. That gives us above average growth. Just trying to sell more of what we already make, I don't think does that very much.
Good thoughts, and that has implications for any business that's involved on the supply or demand side. So thank you so much, Jeff. Thank you all for participating today. This has been the Exporting, Importing, Foreign Direct Investment News program at Global Chamber that we do usually on first Friday of the month. Because first Friday is tomorrow and July 4th, Independence Day in the United States, it's a national holiday, and we decided to move this meeting one day earlier. So thank you for participating today. Catch us the next time for this particular conversation on the first Friday of August, which I think is, let's see, probably the 8th of August. And so in the meantime, there's plenty of other activities, including a conversation on global sales that we're having right now. And I think, Jem, you put the information in the chat area. Anything you'd like to say about that? Are you still there?
I'm still here. No, no comment.
Okay, very good. Jem, are you there?
Hi, Doug. Yes, I'm here. I put also the Zoom link in the chat, so guys, feel free to join us after this session. See you there.
Very good. Thanks. I think you're in both sessions. I don't know how you're doing that. So you have
I'm
to
using my phone.
because I'm in both sessions too. I know how I do it. I'd like to know how you do it as well. Thanks, everybody. Zach Selch is the fellow who's leading the conversation in the sales, global sales. He's got over 10,000 people he knows around the world as distributors and folks to help sell business, and definitely somebody that everybody should know. Jeff also is someone you all should know in your global adventures because he's very familiar with the mega region and what's involved there, and very familiar, as you've heard today, with what the trends are. That's the purpose of today. Jeff, you've been amazing. Thank you so much. And see you the next time. Have a good 4th. Take care.
Thank you. Y'all take care.
Thanks, everyone.
Thanks, everybody.